We had a really interesting day on Wall Street. It started off on the wrong foot, but we actually gained some momentum throughout the day and closed near the highs of the session on most of the major indices out there. Unfortunately, that was not enough to offset some of the more recent negative price action, and our postures largely remain kind of in that bearish territory. We'll talk about all of that. Then we'll get into our trade application example, where I wanted to focus on a particular area of the market, the Cathie Wood stocks, a lot of these high momentum, high growth oriented names that have been absolutely pummeled here recently. And it has me wondering if some of them are getting nearer to that point of where they're going to find a bottom. So I want to show you how to sell a put as a way to exercise a bullish notion on one of those out of favor stocks. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 25th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube and click subscribe on our channel. While you're there, go down to the description area down below and sign up for our email distribution list. That way you can be notified whenever we post these videos. You also have the advantage of getting all of the stocks that have overbought and oversold cluster signals in them in the S&P 500 attached at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee. I would encourage you to follow me if you're not doing so already. And we really appreciate those of you that help support us on Twitter by clicking like and retweet on these Market Outlook related tweets. And then last but not least, we have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's activity. And as you can see, I've got chart 4B pulled up here in front of us. And remember, those of you that are premium members of Market Scholars have access to all 50 plus charts that David and I use during these various presentations. When we're looking at this particular chart, it's basically just a 4-grid that will give us a good understanding of what one particular technical indicator, the market forecast technical indicator, is suggesting in terms of posture. And the background colors of the charts are a nice visual for us to quickly see what that posture is. And so there is something to kind of point out here today. It's the first day in quite some time that we have all of our charts with a pink background color. And what that recognizes is the fact that we now have bearish postures from an intermediate time perspective on all 4 of our charts. So remember, unless we tell you otherwise, whenever you hear us referencing the posture according to the market forecast, what we're basically referencing is this intermediate line. This is the green line on the market forecast, which remember is less sensitive than the blue line and even less sensitive than the red line. So if you want to kind of think about them in order, the red line is going to move around a lot more active. You can kind of think of that as the day trader camp. The blue line is going to move around a little bit more than that. Or I'm sorry, a little bit less than that. And so you can kind of think of that as the swing trader camp. And then the green line is going to move around a little bit less than both of those. And so that's kind of more of the intermediate trend trader camp. And so that's the one that we tend to focus on during these videos. And you can see here that the green line has now fallen out of the upper reversal zone on the S&P 500, which is why the background color of the chart shifted from green yesterday to pink here over that time period. We saw the same thing take place over here with the Dow Jones Industrial Average. In fact, the shift took place just today. So this is the most fresh one here that we see. And that one, you can see, just barely fell out of the upper reversal zone there. Whereas our other 2 charts on the bottom, as I mentioned on Tuesday, they're kind of our problem children. They're the ones that are giving me a little bit more concern, a little bit more grief. Reach for the antacids, right? Because these are the ones that are a little bit concerning for the market right now. The NASDAQ, you can see, is now in this darker shade of pink, as is the Russell 2000. What that suggests is that our green line has not just simply fallen out of the upper reversal zone like we saw on the 2 charts on the top, but in this case, they've rolled over to such a degree where they've crossed the midpoint on that indicator. In other words, less than 50th percentile there. And remember, you can read these in the labels itself as well. So right here it shows us that the intermediate reading right now for the NASDAQ composite is 41.35 and falling. And so, that's considered strongly bearish, as is the Russell 2000. And this one unwound in a hurry. Notice the difference between the NASDAQ and the Russell 2000. We've been pointing this out along the way, of course, but just to kind of make sure we continue to recognize what happened here. The NASDAQ never really had enough oomph in this kind of reversion to the mean type of a move that it made here a couple of weeks back to actually get the green line in the upper reversal zone to begin with. So it was already relatively weak, and now we've just added further weakness to it here in this rollover in the last 3 days or so. Russell 2000 is a little bit of a different story. Here would have been a little bit more of a trap of sorts that could have taken place because the chart was looking relatively healthy up until just about 2 weeks ago. We had the green line in the upper reversal zone, but it unwound so quickly and so violently with this major meltdown right here that took place with the Russell 2000 that we actually pushed this green line from upper reversal zone, in fact, really, really high in the upper reversal zone, close to that 95th percentile, down to currently 44 and falling. So this one had the potential to trap a few more people, and that's a little bit more concerning because it opens up that possibility that people that were buying the small cap stocks during this breakout move right here might have felt like they got trapped. And if that's the case, it's possible that as we get any sort of a rally for the Russell 2000, it's possible that those folks that felt trapped will try to get out at break even. We are, a peculiar bunch, us humans, when it comes to that. And we kind of anchor our trading experiences to where we bought or sold a particular security. And so if somebody were buying small cap stocks here on the breakout, it's entirely possible that a lot of people felt like they made a mistake when they look back right now. And if they can get back to kind of break even there, that's what effectively creates the resistance of the selling that might very well take place in the future. So be on the lookout for that possibility there. Both the NASDAQ and the Russell 2000, they're still concerning. Both of them still have your red moving averages here that suggest price is below a falling moving average as well. So it was great to see them up today. Don't get me wrong. It's, I'm somebody who certainly benefits when markets go up over the long term. So I'm not a guy that's going to cheerlead the markets to the downside, but I'm also a realist. I recognize, that markets don't go straight up. There's going to be times where we have to give back some of those gains along the way, and we're kind of going through one of those periods right now. So the NASDAQ was up 0.12% today. The Russell 2000 actually had a pretty stellar performance. It was up 2.29% today. But again, it wasn't enough to kind of offset all the losses that it had here recently, and we still had that shift from a weakly bearish posture to now a strongly bearish posture. Of the two charts up on the top, the S&P 500 was up 0.52% and the Dow Jones was up 0.62%. It is the Dow Jones that appears to be the star of the market right now to my eye. Notice the difference in the behavior of the Dow Jones compared to most of the other indices there. The Dow Jones indeed did hit an all-time high here just about a week ago and has pulled back in the last week like so many of the other indices have. What makes it different is that it didn't cut through that moving average. In fact, we haven't even touched the 30-day moving average yet. So there is more resiliency here. We talked a lot about that in my question and answer session for my premium students here earlier today, how this is a market that is drifting towards dividend stocks and blue chip companies. And of course, those are the types of companies that make up the Dow Jones Industrial Average. So I was happy to see the Dow up 0.62% today, and I was equally as happy to see it bounce prior to even touching the moving average. That's a sign of tremendous strength right there. Now, is this move lower in the Dow here over the past week done? That remains to be seen. I don't think we can write the final chapter of that story quite yet. We might very well roll over in the days to come, but every one of these pops higher kind of gives you the impression that participants within the Dow aren't particularly enthusiastic about sending it that much lower. So I think if you're looking to kind of play the markets from the bullish side of the equation, then some of those big blue chip companies that oftentimes are perceived as too boring or too mundane to look at as trades, they're actually what is in favor in the market right now. Now, a lot of you might very well decide not to do any bullish trades whatsoever, and that's perfectly fine as well, because as I stated before, we now have bearish postures across the board from an intermediate perspective. So sometimes people just want to play the wait and see approach. Some of you might get a little bit more aggressive with bearish trades. You know, I did the bearish trade on Tesla on Tuesday, showed you how to do that. So, you know, there are ways to make money if you want to get bearish in the markets, but some of you might not feel comfortable with that. And so remember, there's no shame in just saying, okay, we're in a choppier period right now. I'm going to stay mostly in cash or, you know, kind of in safer investments until, you know, some of this skirmish gets pushed to the side. So that's the environment we're in right now. Not a great one, but one that you can manage through. It's not the most devastating market we've seen, that's for certain. Let's go ahead and take a look at our 3 green arrows setup now, and that will be chart 4D here. And as we're looking at the 3 green arrows, reminder that this chart 4D will show us the background color if we have a 3 green arrows setup or a 3 red arrows setup. Right now, we don't have any examples of 3 green arrows because we've got some red arrows up here on the S&P 500 and the Dow Jones Industrial Average on the MACD histogram. So we've got a mix of green and red arrows on those two, and that's why the background colors are white on those two. However, on the bottom two, again, our 2 problem children in this environment, we do have red or pink background colors here, and that is because they have 3 red arrows. What I'm referencing there are just simply 3 technical indicators that we like to judge to see if they are giving us bullish or bearish considerations, and to see if they're all kind of lined up around the same time period. And that is the case with the 2 charts on the bottom. We closed below the 30-day moving average here on the NASDAQ composite on March 18th, which is why we received that red arrow there. A few days later, we received a red arrow on the MACD histogram when we lost momentum further. And then we also received a red arrow on the stochastics here a couple of days ago. Remember, the stochastics tend to measure where a stock is closing over various trading ranges. And when you see the red arrow starting to appear, it's giving you the sense that the stock is closing near the lows of various trading ranges. Of course, that's the opposite of what you'd want to see if you want to be bullish in the markets. And so we did see that activity on both the NASDAQ and the Russell 2000 here over the past week or so. And again, just to reiterate what I mentioned previously, both of those have red 30-day moving averages, suggesting price is below a falling moving average. And the fear there is what I shared with you a few weeks ago when we talked about the NASDAQ in this exact situation, which is once you start getting comfortable trading below a falling moving average, the fear is that once you approach it again, it becomes resistance. And the NASDAQ has already proven that point once about a week ago. We haven't really played that game too much with the Russell 2000, so I'll be curious to see how this shakes out. If it does test that moving average, is it going to get through it? Or is it going to use that as an excuse to sell it off and roll over? So it's going to be interesting to see, because we do have a little bit more diversity in our indices right now. Remember, that's not always the case. A lot of times these indices will kind of move in unison with one another. But right now, we've got quite the wide variety. We've got the Dow Jones that looks still reasonably strong. And then we've got, the Russell 2000, the NASDAQ that look pretty ugly, if I'm being honest. So be on the lookout for that. Let's take a look at our 1040 crossover method here. Now remember, this is Thursday, so this particular chart is going to use weekly candles, and therefore there's still one more day left of this week, and so we can't really put a bow on it quite yet, but we're close enough to get an idea of any sort of changes that may or may not be taking place here. And so as we look back on these charts, these are 3-year charts that will basically have candles, the individual candles that are 1 week in length. And as it stands right now, there is something worthy of pointing out, and that is the Russell 2000. You'll notice here the Russell 2000 has a red arrow showing up above its candle this week. What that is referencing is that its price is currently trading below its 10-week moving average. Remember, on this chart, The orange line is the 10-week moving average. The blue line is the 40-week moving average. What we're really looking for are the crossovers of the moving averages themselves, but as most of you are aware, that happens quite infrequently. A lot of times you have to wait several months before you see a crossover take place. In the meantime, you try to see if there are certain markers that exist, certain storm clouds in the sky that could potentially lead to further stress on the system. And one of those is just simply price closing below the 10-week moving average. So we have a long ways to go. I don't want to make it seem like this is a dire situation here, because it's not. The orange line is tremendously higher than the blue line here. In fact, these are some of the widest moments you'll ever find for the Russell 2000 in terms of how far away is its 10-week moving average from the 40-week moving average. In and of itself, that might very well even be one of this market's challenges. It might have gotten so overheated to the upside because that move out of the Russell 2000 was so tremendous that a give back could be a little bit more aggressive. And even if there is a more aggressive give back, it's not even a destiny for the moving averages to cross because we have so much room between those two moving averages right now. So we'll see how that shakes out, but I would not anticipate a crossover of the moving averages anytime soon for the Russell 2000. The NASDAQ is a little bit more concerning. Notice the pinching taking place between the orange and the blue lines there. They're getting quite a bit closer than what we see over here with the Russell 2000. Even that's going to have to take several weeks before we would likely see a crossover, but what I see on the charts in front of me right now suggests that if we are destined to go into maybe a little bit more bearish environment in future months, I would speculate that the NASDAQ composite is probably going to be the one that gives us the bearish crossover first. Some of you might refer to that as a death cross when we're talking about the 10-week moving average versus the 40-week moving average. The Dow Jones looks great. The S&P 500 is just kind of neutral. And what I'm referencing there is, notice the green line down below on the PPO is kind of just going sideways on the S&P 500, basically meaning that the orange line and the blue line are basically kind of going up at the same rate. They're not really separating from one another. When you have a slight tilt on the green line on the Dow Jones, like you see right here, what that is suggesting is we're actually seeing a bit of an acceleration in the short term for the Dow Jones. In other words, the more sensitive 10-week moving average there in orange is going up more rapidly than the less sensitive 40-week moving average there in blue, and that is generally perceived bullishly. So again, this is a different type of a market where some people might refer to it as a stock pickers market. In other words, you don't just kind of ride the flow of the entire market. It does pay to be involved in certain segments of the market, and right now what the market seems to be preferring is kind of those blue chip types of companies that you would find in the Dow Jones. Let's pop on over to the internet here briefly. Now, I brought this up on Tuesday in my video as well, but just to reiterate once again, we have a slight handle change on Twitter for our corporate account at Market Scholars. You can see it kind of listed right here. We used to have a underscore in our name, but we were working with Twitter support here over the last weekend, and we're finally able to get that resolved. And so all of our followers transitioned over with us. So if you had been following us before, you're likely still following us now. So there's nothing you need to do on your end. Just making you aware of that, because sometimes when you guys tweet things out, you try to tag us to let us know, and that way we can, send our appreciation to you and all that kind of stuff as well by clicking like. So some of you might have been in the habit of using the underscore in the past. So be aware that going forward, if you're trying to tag us on Twitter, you would just put the @ and then Market Scholars, all one word, after that. Also, I should point out that we had a really nice comment earlier today from Ian McMillan. He's a great guy from what I can tell. He's a guy I've really looked up to and admired there on Twitter with all of the chart work that he does. And so, Ian, if you're listening, thank you very much for the lovely comment that you gave to your followers today. And I would send it right back to you. If there's any Market Scholars followers that are not following Ian, I would highly encourage you to do so. He has some of the best charts in the industry. And what I like about him is his work ethic and his consistency as well. He is constantly churning out charts. So make sure you check out Ian's Twitter handle if you get an opportunity there as well. Over here now to our last time I did the video for you guys on Tuesday. I always like to get a chance to say thank you to those that help support this particular product on YouTube. Remember, it is free. We don't monetize it. We don't make money off of this video here that we try to put together for you on a daily basis. So it does take a couple of hours out of our day. If you want to thank us for that and encourage us to do it as often as possible going forward, we ask one simple thing out of you. Just simply click like for us there on Twitter. As long as we're getting up and over 100 likes, I'm satisfied with that, and we'll continue to do it. If we're getting less than 100 likes, then, of course, we'll have to consider whether it's worth our time or not. So thank you to the 106 of you that did that for me on Tuesday. You guys are awesome. Earlier today, I taught my question and answer session. And so you have access to that recording now up here in our trading rooms if you are a premium member. We had some excellent conversations, as we always do. I was asked about Southern Jersey, a utility company. I was asked about Oracle. I was asked about a Citi article regarding high dividend yield versus high dividend growth, and how you kind of juggle those two during different market environments. I had a question about how do you set up multiple accounts on the Thinkorswim platform. Had a question about Pfizer as a possible dividend growth investment. Speaking of Pfizer, I got my first round of my vaccine shot yesterday. There was a last minute cancellation, so I hurried down there and got my first one. So hopefully I'm on my way. I know many of you are as well. So hopefully we can see the light at the end of the tunnel there. We appreciate Pfizer and Moderna and Johnson & Johnson for helping us along here in this society. I also got a question on stop losses or other ways to kind of manage through more difficult market environments depending upon the strategy that you are managing. And then also I had a question about Etsy as a longer term holding. So if you're interested in that content, it is available for our premium members on our calendar right now. Also should mention that tomorrow we have our very popular technical analysis class at 1 p.m. Eastern Time. If you've ever wanted to be taught by a chartered market technician, then tomorrow is your opportunity. Of course, David Settle is the best in the business, at least from my perspective, one of the best, certainly. And if you wanted to be taught by his hand, then every Friday at 1 p.m. Eastern Time is your opportunity to do that. So make sure you check out his classes when you get a chance there. I talked about the factor selector a bit on Tuesday, but just to put a ribbon on it, since I didn't show you the overall graphic at that time, I did want to point out what I had mentioned on Tuesday, which is we are seeing some very interesting movements within the market itself. Dividend yield is really firing in all cylinders right now. Again, that is the same concept that I mentioned earlier when we were looking at the Dow Jones Industrial Average and its performance versus the Russell 2000. In a way, you could replace dividend yield here with Dow Jones Industrial Average and replace size here with Russell 2000. And that flip-flop of the rankings week over week tends to make sense given what we've just seen in the marketplace here more recently. So that was an interesting observation that we saw here this week. Value stays number one from a factor perspective. Now, that's been the case for the last few weeks, so that's not a big surprise there, but they retain their strength well enough. And then the other big story is what happened at the bottom here. Momentum is now dead last. It has been a long, long time since I've been able to make that claim. I want to say it's been over a year since momentum has been dead last on the factor selector. That is really saying something. In fact, low volatility had been dead last for many months. Remember, this is a rolling 3-month graphic here, but if I were to go back several months prior to this graphic, low volatility was in the last place position for the vast majority of that time as well. So that was a pretty big upheaval at the bottom, and just goes to show you how many of those high growth oriented stocks have really been taking gut shots here more recently. And so the proof is in the pudding. We now have momentum on the downside of the market. Let's get back over to some other Thinkorswim charts now. And I wanted to pull up a supporting chart there just to kind of give you a sense from the Thinkorswim perspective what some of these factors look like. And you'll notice here that there's a couple of them that really stand out to the downside, and that is momentum and low size. Notice both of those trading below their falling moving averages. Those are the only two that have red moving averages right now. So those are the two that are struggling the most on a relative basis. Those that are doing well on a relative basis are going to be your dividend yield. Notice up here in the upper left, it's doing pretty well. You've got a green moving average there, prices above a rising moving average. I wouldn't really say quality is doing great, but it's holding up well enough where it does also have a green moving average. But in particular, we also see strength out of value down below. In fact, value is setting up as kind of an interesting bounce candidate right here. This is the behavior you like to see if you're a swing trader, where you've got a chart that's going up, you have this little bit of a give back right here, and where do you find support? Right at that rising moving average. So be on the lookout for a potential bounce out of some of those value names in the coming days. Let's go ahead and take a look at some 12 grid analysis now, starting with the asset classes. Wanted to point out crude oil because, of course, it's been in the news here quite a bit lately. That's the chart on the bottom rung here, second from the right. Crude oil has been kind of back and forth depending upon how the story is playing out there with the container ship stuck in the Suez Canal and kind of blocking things up there. Today, crude oil fell back down again after having a really nice day yesterday. Remember what I mentioned on Tuesday, the fear with crude oil is that now that we've sliced through that moving average, your attitude around this chart is likely to change. I'm not saying it's down and out forever. We've had such a tremendous run here, it might need a more aggressive give back before we get back on course to higher ground. But at this moment in time, you've got to learn to play it safe. Remember, crude oil is an area that has burned a lot of people in the last 3 or 4 years. And so, there's only so much abuse you can take as a trader or an investor when it comes to crude oil, and you're just going to be a little bit more quick on the draw to get out of some of those trades. And like I mentioned on Tuesday, unfortunately, we were stopped out of some of our crude oil related trades that I had put on in these presentations previously. So it's the way it goes, but sometimes it's healthy from a psychological perspective to kind of clear the deck. Getting stopped out, hurts that first day, but it gives you kind of calm and comfort in the days after that, as you can kind of, look at the markets from maybe a more consistent mindset and maybe look for better setups that are out there. So right now, I think crude oil is worthy of keeping on your radar because it's not that far away from the moving average, but not necessarily at a place where you get excited about buying it right out of the gate right here. Between crude oil and gold, which was also down today, not nearly as much as crude oil, but gold was down another 0.36% today. The gold chart is still concerning to me, much more so than oil. And as I mentioned before, it's not that I want to say that. I actually think gold could be interesting for the long term, but right now, from a trader's perspective, in the near term, we're still in that dangerous territory. In fact, where we are positioned right now, could suggest that we're about ready to roll over yet again to the downside after kind of resolving some of these oversold cluster signals that we've had here more recently. Now, of these charts, one of the more interesting developments has been what has happened with the US dollar. I brought this up on Tuesday as well, and we've had nothing but further upside action since then. In fact, this has been important last couple of days since I was last with you, because on Tuesday we ended right there. And I was pointing out that we were just a hair below that prior candle on UUP on March 8th. And so who knows, maybe that would end up being some sort of a resistance. Well, it wasn't. This has been a freight train type of a move to the upside on the US dollar. Remember, when the US dollar is strong, it does have a tendency to put weakness into commodities like gold and oil, and it also has the tendency to have some of those foreign markets struggle a little bit. Today, the emerging markets did not perform as well as the U.S. markets. However, the developed markets did slightly outperform the S&P 500. However, look at the 3-month perspective of those charts up there at the top. The S&P 500, despite all of the people that feel like we're in some sort of a really chaotic market, and I'm guilty of that as well, certain pockets of the market have struggled, without a doubt. But despite all of that consternation, the S&P 500 is still up nearly 5% over the last 3 months. That is outperforming the developed foreign stocks that are only up about 3.5%, and then the emerging foreign stocks are only up about 3%. And like I mentioned on Tuesday, it's the emerging markets chart that is the most concerning here. And that's been the case for the last month, so this should be no new information to you. It's just a confirmation of what we already have known for the last month. This is a problem child here, just like the NASDAQ chart is a problem child. What I can say about the EEM in this case is that we do at least have maybe a ray of sunshine where maybe some of this intense selling that we've been seeing in the emerging markets is about to get resolved to the upside just a little bit. Now remember, when we start seeing these oversold cluster signals, so let me right click on the chart and go to maximize the sell, it's basically telling us that these 3 different lines, the green, the blue, and the red lines, are all in the lower reversal zone below 20 on the same day. That generally gives us a suggestion that we have oversold conditions. Now, just because we have oversold conditions does not necessarily mean we are due for some sort of a dramatic bounce, but it is true that more times than not, we do end up having some sort of a bounce. Whether it's an aggressive bounce or whether it's a whimper remains to be seen. But don't be surprised at all if we do get some sort of a reversion to the mean type of a move out of EEM, maybe get ourselves a little bit closer to that falling 30-day moving average again. But at this point, my assumption is that that will be very fleeting in nature and that the downtrend in EEM continues. Now, obviously, that's not going to be the case forever. Eventually, that will change. And when it does, I'll do my best to change right along with it. But right now, you kind of have to go into a situation like that, kind of expecting the worst. This is clearly a chart that is damaged goods right here. Lower highs, lower lows. And so, be on the lookout for maybe those of you that felt like you got into some of those emerging market stocks incorrectly. Perhaps you'll get a lucky bounce here soon to get out better than you would have otherwise. And for those of you that want to be more bearish on EEM, look for that potential bounce to then sell a bear call spread or do something bearish up here as we approach that falling 30-day moving average. All right, let's get into our trade application example today. And as I mentioned previously, this is going to be a kind of Cathie Wood special, as it were. For those of you that are not familiar with Cathie Wood, she has taken the investment world by storm in the last couple of years, as many of her ETFs have just done extraordinary performance. So like ARKK is one of her chief ETFs here. This is the ARK Invest Innovation ETF. And for much of 2020, it was just gravy to the upside. All you had to do is copy Cathie Wood, and you were hitting home runs. Right? Many of those stocks were up hundreds of percent, and it just seemed too good to be true, and eventually it became that way. And this is a hot topic. You guys that follow me on Twitter know I've been bringing this up for a few months at this point regarding the idea that Cathie Wood is so transparent in her moves because she is a rare ETF manager that will actually point out her transactions on a daily basis. Remember, most ETFs are just passive following ETFs. They might follow the S&P 500 or follow the Dow Jones. Cathie Wood has more of an active approach to her ETFs, and she lets you know what she's been buying and what she's been selling every single day. So much of 2020, there would be a lot of people that would just simply follow her moves, copycat types of moves. And that worked out really, really well for them as momentum was really in favor. When momentum's in favor, you can get away with that kind of just hanging on to the coattails of whatever's working. Well, there's been a break in momentum, as I just showed you earlier with the factor selector. And so that approach really has not worked out very well here in the last month or so. We've seen this chart really start to break down. Remember, this is an entire ETF that has dozens, if not hundreds of holdings within it, and it's gone from 159 here on February 16th to down here at 114 right now. Now, one of her more popular stocks that she has been buying in her ETFs is a company that many of you probably have used within the past year, which is Teladoc. And Teladoc kind of caught my eye today. First of all, I talked about it briefly in my question and answer session, but it caught my eye today, firstly, because it kind of broke down below this prior resistance area, prior support area right here on March 5th. And so sometimes when you see that, it has a tendency to kind of flush out the weak hands. A lot of people might have had a stop loss a little bit below that candle. Today, you might have had a situation where you flushed those weak hands down. Notice the long lower shadow on today's candle. That suggests that while we did have some intense selling at the beginning of the session, we actually closed this stock close to the highs of the session. So again, be careful with that. It was still a down day for Teladoc. It was down over 3%, but it was down like 5 or 6% earlier in the session. So there was some tremendous strength coming into it. The bulls didn't just roll over. They had some resiliency there. The other thing that caught my eye about it is, despite breaking this prior support right here that just happened in March, they did not breach this support level over here from what was it? It was November 10th. Notice that on November 10th, the low price was 168.50. Today's low price was 169.01. In other words, you had about 51 cents before you would have breached that low. So you were able to hold those lows at the same time you broke the more recent ones. That presents an interesting situation when you have a long lower shadow there. Some of you might be a little bit more aggressive in how you would handle this situation, and you might decide to try to trade this to the upside with a stop loss slightly below the low over here. It's not exactly the way that I approached it with our trade application example. So that was one thing. The other thing I wanted to point out was some of the clusters. Now, unfortunately, by the end of the day, remember, I do these trades earlier in the session and I tweet them. I don't tweet them out. I put them on our Telegram app for those of you that are premium members. So that way you guys can look at taking some of these trades as well while the market is open. At that time, we actually had an oversold cluster signal on the market forecast on a daily chart. Now notice we had one of those over here as well. It didn't really lead to much, so that's not going to be necessarily the world's greatest signal here, but it could have been at least one more reason or excuse to think about kind of a reversion to the mean type of a move here. However, I do want to point out one thing, which is if I were to go to a weekly candle chart, remember right now I'm on a daily candle chart. Let me now go to a weekly candle chart. I want to show you something because we do have an oversold cluster signal on a weekly candle chart right now on Teladoc. In fact, this is the only one on the board over the last year. I don't know how long ago since it's been an oversold candidate on a weekly candle chart, but in fact, as I go on a 3-year basis now, this is still the only little green dot you see down below in 3 years. Maybe I can go back 5 years. I don't remember when they did their IPO. But even if I go back 5 years with all the data that we have on the chart, there is no other time except for right here, right now, where we have an oversold cluster signal on a weekly candle chart using that market forecast technical indicator. Now, that's not a guarantee of anything, of course. It just goes to show you the extreme sell-off that has just occurred in this particular security from 308 here about a month or so ago down to 176. And a lot of that is because that positive momentum that was going into these types of stocks when Cathie Wood's funds were doing so well, that negative momentum is now affecting it the same way. In other words, when Cathie Wood's ETFs are going lower, the stocks that she owns in those ETFs are going to be sold as well. So what it has me wondering here is if we have an opportunity to recognize a deeply oversold stock and to do some sort of a bullish trade on it. Now again, some of you might be aggressive enough where you're just going to buy it to the upside. It's not really my style. I want to take it a little bit easier because, again, I recognize this is not exactly the market for this type of a stock. This is a market that loves kind of your blue chip types of companies, and this is not one of them. So I want to play it a little bit safer, and one way that you can do that is by selling a put. Now, what I ended up doing was selling the 145 put here earlier today, and it was for the April monthly contracts. Now, I chose April over May because they will have an earnings announcement at the end of April. In other words, I don't want this earnings announcement to negatively impact my trade. I just have to be in this trade for the next 22 days until the April monthly contracts expire. And as long as it doesn't go down an additional $30 per share down to 145, then I should be able to make money off of this trade. So that's what I opted to do in this case. Some of the times I might have gone to the maze, but in this case, because it has high implied volatility and because we've got this earnings announcement coming up, I was able to get a trade done close to a 1% return on risk, taking less time exposure in it with an up and coming monthly expiration there. And again, if you're a premium member, check my Telegram channel to get the trade details there each time that I do these videos on Tuesdays and Thursdays. So that's what I had for you here tonight. A little bit longer video, but we had to go over a little bit more here today because it's a little bit more of an exciting day where you had a little bit more of this bottoming type of action that was taking place despite some of the postures that are still bearish out there. So treacherous territory without a doubt, but if you keep your eyes open to it, there are opportunities that exist. So as always, I appreciate your attention during the presentation here. If you could do me one simple thing, go over to Twitter and click like for me there. That'll go a long ways for us. And remember, join David's technical analysis class tomorrow if you're a premium member. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.